Tax season is just around the corner. Are you ready? We're joined in this webinar by Georgia Swan, tax and estate planner at TD Wealth, as we discuss common tax approaches for a self-directed investor. Learn about the main types of investing income for tax purposes and the tax slips expected to be received. We'll also explore some common tax strategies to use and best practices to help you prepare for the tax season. Finally, we'll look at the resources available to you on WebBroker that can help you prepare for tax reporting. And without further ado, I welcome my guest, Georgia. Georgia, how are you today?
I'm really good. It's good to see you today.
Well, it's good to see you today. So talk to us a little bit about what we're going to be looking at today with you.
So today we're going to be talking a little bit about the differences between 2020 and any other year when it comes to taxes, because we've had some new things that have come about, obviously. We're also going to be reviewing some of the basic and usual tax documents and tax slips that DI clients can expect to receive. And then towards the end, we're going to be talking about some tax planning considerations that I think people should think about. And one thing I do have to say about those is those are not only end of year issues. They should be something you should be thinking about all through the year.
Yeah, I think that's something that always happens to us. We always just only think about taxes when it's one part of the year, but you're right. We should be thinking about it all year long anyway. So let's start out with some important dates, just so people can get those down over the course of 2021. What are some important dates that we should note this year?
Well, the first one, of course, is March 1st, 2021, which is the deadline for making any RSP contributions that you want to actually count for 2020. So that's the first thing to keep in mind. And then, unlike last year, when we were given some grace periods with respect to filing our tax returns, it doesn't look like we're going to be given those gifts this year. So we have to go back to April 30th, 2021 is the filing deadline for T1 returns and the date upon which, if you owe any tax, you have to have it remitted. June 15th, 2021, if you're a self-employed individual, you have to have that tax return in. But remember, again, if you owe tax, even though the return doesn't have to be in until June 15th, you should make sure that any tax owing is in by April 30th. And then, if you are a trustee of a trust, you have to remember that trust returns are due 90 days after the year end. Or in most cases, because trusts have a December 31st year end, for this year it'll be March 31st. And one of the things I do want to say is if anybody out there is holding funds on behalf of somebody else, this is the year to actually go get some good legal and tax advice about trusts, even if you think that they're an informal trust, because there have been some new tax rules that come into effect this year that require trusts that never used to have to file tax returns to actually start filing them and giving quite a bit of information. So this is the year that if you hold an account and in your mind you're holding it on behalf of somebody else, even if you didn't think it was actually a trust before, go get some advice from a lawyer or your accountant to see if maybe now you have to start filing a trust return for that account.
Excellent. That's great to consider. So throw those dates in your calendar, everybody, and as well, when it comes to those trusts, get that advice from legal or tax. It is something that is always important. So in 2020, I know it was a crazy year. Now, there are a whole bunch of new government benefits that we heard about that we might have not heard about before. Can you talk a little bit about those?
So the emergency benefits that the government introduced last year in order to help us through the pandemic were important because some of them are and some of them were not or are not taxable. So you need to be aware of what you actually applied for and whether you have to report it on your 2020 income tax return. So for most people, I think the most common one was the CERB. So if you did apply and qualify for the CERB, you can expect to receive a T4A slip, and that money has to be reported on your income tax return. That's the same thing for the Canada Response Benefit. The only difference for that one is that there was 10% withholding tax on those, and the Canada Recovery Sickness Benefit also had 10% withholding, as did the caregiver benefit. So if you received any of those funds, you should be aware that you do have to include it in your tax return. The other thing, the student benefit, if you received that, you will receive a T4A slip, and that also has to be included. The only thing that doesn't have to be included is if you got that one-time disability benefit or the seniors benefit. And what's most important about these is to really check if you do receive one of the T slips because you've received that particular type of benefit. Check to make sure it's accurate. As you can imagine, all of this stuff happens so quickly, and you shouldn't take for granted that maybe the government might make a mistake on some of those forms. So make sure that you check them against what actually went into your bank account.
Yeah, thanks for that. And yes, always do that double checking. So let's move things on to some other types of tax slips, and more specifically, what we have available for clients here at TD Direct Investing. So what kind of, in a sense, what kind of tax package do we offer clients on WebBroker for their accounts?
Well, first and foremost, when you get your DI tax package, you're going to find a cover page and a checklist of the most common tax slips. And I know that that list can seem really long, but the truth of the matter is that those are all of the slips for all the different types of investments you could possibly have. And it is a regulatory requirement that those be sent out. So as overwhelming as it seems, I think if you really look at them, you come to realize there's a pattern, and it becomes a little bit easier to differentiate. So you will also get a foreign property report, a help guide, the realized gains and loss report, in the package. So wait for that, and once you receive it, as I said, if you sort of take it step by step, it becomes a little bit easier to understand where all of that different information goes.
And we'll take a little bit of a tour of WebBroker in a little bit, and I'll show you where you can get all of that information, including that tax package. So when we now turn our eyes to a lot of the documents that are going to be received by self-directed investors here, at TD Direct Investing, I guess we could categorize them or put them in two or three categories. One, registered accounts, one, non-registered. Let's start with some of the more common ones you would get, some of the more common tax slips you would get on your registered account. What would those be?
So here's one little secret about registered accounts. For all registered accounts, generally, the tax slips will be those T4 RSPs, T4 RIFs, or if you're in Quebec, they'll be Relevé 2 or Relevé 1s. So whenever you see a 4, you can pretty much be certain that it's going to be something to do with a registered account. So some of the common ones are the RSP contribution receipt, so they will show all your contributions for the year. Incidentally, if you see NR before one of the slips, that means non-resident. So I assume if you get one of those, you know you're a non-resident. But if you get one and it says NR in front of it, you should probably be, and you know you're not a non-resident of Canada, you should probably be checking into that. But that just shows you sort of there is a little bit of a method to the madness of naming these things. So a T4 RSP basically deals with any withdrawals from any of your RSP accounts, or a T4 RIF deals with withdrawals from a RIF account. And those you can usually expect very early in March. So they go out about March 1st. The non-resident slips go out towards the end of March. Quebec residents basically will get their Releve 2, so they're submitted with the T4 RSP or T4 RIF statements, and they also go out very early in March, around March 1st. And then RESP withdrawals come out on March 1st, and they're a T4A, as well as with our DSP, so Registered Disability Savings plans. They also come out in early March. So as I said, if you just really look at the name of them, as time goes by and you get used to seeing them each year, they become a little bit more intuitive. And if you just remember, if you see that 4, it most likely will mean it basically means a registered account.
That's a nice trick. I never knew anything about that 4 thing. So now I'm learning things in this particular webinar. So thank you. So let's move our attention over to non-registered accounts. What are the kinds of slips or documents that we're going to get on our non-registered accounts?
So non-registered accounts, here's the secret on those. For those, you're basically going to see either a T5 or a T3. So the most common one, or for Quebec purposes, it'll be an R3, RL16. So if you look at those 3s or T5s, that's when you can be reasonably assured that you're dealing with a non-registered account. So a T5 R3 for mutual funds is basically income distributions from corporate class mutual funds, as you know the slides talk about. There may also be a T3 RL16. So those are distribution and return of capital, again, from mutual funds. You'll have, if you have any dividend or interest income, you'll be receiving a T5, and all split corporation income will also be coming on a T5 R3. And those are typically actually, when we're talking about the T5s with respect to mutual funds, the first one, so the T5 R3, that typically is received right from the fund company, and it comes in early March. The other T3 RL16 comes in late March. And then for dividend and interest income and split corporation income, and then your T5008, which is a really important one because it basically talks about all your dispositions. So redemptions, maturity, all that stuff. That those last 2 usually come out in early March. So the hope is, you know, I guess the next kind of little secret is, if you think you might have one of these, don't rush your tax returns. You may have to wait until fully into April to make sure that you have all of the information you need. But the hope is, as you go on in the year, that you've kind of been keeping track of these things and maybe already have an idea of, you know, of estimating what you think your tax liability is going to be. So that's another important sort of tip, I guess, for throughout the year. You should be trying as best you can to keep track of this stuff throughout the year, because the hope is that very early or very late in one year or early the next year, you should be starting to be able to estimate what your tax liability might be.
Yeah, no, it's always a good thing. And we mentioned it at the beginning, always to be following, because then we can expect certain things and not rush to do those taxes beforehand. You mentioned the word disposition, and I just want to clarify for those that don't know the word, what disposition is. Could you just clarify what the word disposition actually means?
Sorry, I guess I'm thinking too much like a tax lawyer there, but it basically means a sale. So disposing of an asset, and that's what it is. It's basically a sale. The interesting thing is about tax, though, is sometimes there are circumstances where the Income Tax Act will basically deem a disposition. You won't have actually disposed of something, in other words, sold it, but the Income Tax Act will treat it like it is. And that's actually something I sort of didn't talk about before. Another slip you're going to get is the realized gain and loss report. And what's interesting about that is that both US and Canadian accounts are consolidated on that report, and the US amounts will be converted to Canadian funds. So that's another important one to look for when you do have a disposition. So look for that one in your package as well.
Excellent, excellent. So just to clarify, so if we are trading in US dollars, all of those trades are actually converted to Canadian? Is that how it generally works when we're doing our taxes?
Yep, in the realized gains or loss report, it will be converted. So it is important, though, to make sure, because on these slips and on anything that you receive, it will indicate if the numbers are being presented in Canadian dollars or US dollars. So it's important to really read these documents and look at that just to make sure that you are converting things properly if you have to.
Okay. Oh, that's good to know. Any other tax slips for non-registered accounts that we should know about or we might get?
Yeah, there's a lot of other ones. I mean, some of these perhaps maybe aren't applicable to everybody, but if you have trust unit income, again, you're going to receive a T3 slip, typically in late March. Partnership income, you will receive a T5013 or an RL15, again in late March. If there are any distributions, remember, if you are a non-resident, you will be receiving a couple, some non-resident slips or NR slips. So any distributions to a non-resident, they would receive an NR4. There is, if you receive U.S. income, now those are the ones that even I don't like to look at, but we have to look at them. And so those are 1042S. So if there's U.S. source income, if you're actually a U.S. person and you're receiving income, there are other slips that also happen or are received. So it's a 1099 INT-US. And you have to think that, again, these are intuitive. So think that a 1099 INT means interest. So those usually go out in early February, or a 1099 DIV means dividend, and a 1099B means a U.S. person receiving proceeds from a sale. So these are all things, if you do have a U.S. connection and you are considered a U.S. person, you will be, or you're probably used to receiving some of these. Now, on that issue of what constitutes a U.S. person, I think I want to make our direct investing clients aware to the fact that there's a lot of people walking around that are considered U.S. persons for tax purposes in the US, but don't know it. So if you were born in the United States but never actually even lived there, or if you have parents who were born in the United States, it is a good idea to go get advice from a U.S. tax lawyer or accountant to make sure that you're not considered a U.S. person, because if you fall under any of those criteria that I just spoke of, you could actually be a U.S. person. And if you're not aware of that, and you haven't been filing tax returns in the United States, it could catch up to you. So these are some things maybe to be cognizant of if you do have a familial connection in some way to the United States.
Of course, that's something that a lot of our clients might actually have to consider going forward. So those are some of the main documents that we're looking for when we're in WebBroker. When we're in CE services, we have some other documents that pop up there that I kind of wanted to go through. Some other non-government reports. Could you talk a little bit about those as well?
Yep. So If you're receiving any kind of a T5 through our system, you will get an investment trading summary. So that is basically exactly what it sounds like. It's a summary of all the investment trades that you've done. If you're not necessarily receiving a T5, you may also just receive a straight trading summary. You'll receive a summary of trust income, which excludes mutual funds, and a pending trust unit summary. So all of these come at various times throughout March. They're non-government reports, but they'll give you the information that ultimately, basically, you need in order to finish your tax returns. Now, again, as I said, with any documents you receive, whether it's T5s, T3s, T4s, it is important to really look at them and see if they make sense to you. I mean, I'm not saying that anyone makes a mistake often on these documents, but sometimes there can be a mistake. And if you see something that seems very different than what you expect it to be, it's important to basically follow up and see if maybe there is a concern from that perspective.
No, that's a good piece of advice. And it also comes to the same idea of keeping an eye on your account and considering taxes all year long so that you're aware of an error if there is one. So let's take a quick moment and go into WebBroker, and I'm going to show you how to get a lot of these documents, where to get all these documents.
eServices allows you to access your account documents online, view and download your account statements, trade confirmations, and tax documents anytime, anywhere with eServices through WebBroker. Not signed up for eServices yet? Well, it's easy. From the WebBroker homepage, click on Accounts. Then click on eServices. Click on Sign Me Up. Read through the consent to electronic delivery of documents. Enter the email address where you'd like to receive notifications and click I accept. All done. Any documents available for the past 7 years or from the date you opened your account, whichever is more recent, will be instantly available. What if you wanted to look at how you did on a trade in the past? If you no longer hold a stock, it no longer shows in your holdings. That's where the gain and loss page comes in. On the gain and loss page, you can see all of your closed trades over the past several years and get a clearer picture of which stocks made you money and which ones cost you. Again, there are multiple views. If you want to see how you did on a particular security, use the Buy Investment view. If you want to see how you did on each trade, click on the security's name or just use the Buy Transaction view. This gain and loss tool can be really handy at year-end when you're trying to figure out your gains and losses for the year, particularly if you trade a stock actively and want to see how you did on each individual trade during the year. Also, if you're a buy and hold income investor, you can use the Buy Investment view to see the interest and dividends you received on a security throughout the year. Or select the Buy Transaction view and see each and every payment made by the stock individually. The main filtering tools, however, are found up here. This first one allows you to select the account or group of accounts you wish to look at. Next, this filter here allows you to select which calendar year you'd like to look at, and this one allows you to zero in on a particular type of security. If you want to get even more specific, you can use the advanced filter options here. With advanced filters, you can enter a specific stock name or symbol to quickly find that security within the list. Lastly, if you prefer working with spreadsheets, WebBroker allows you to export this data to help you do your own analysis. This little icon with the box and arrow at the top of the page, called the export icon, converts this table into a spreadsheet. Here, you can see the account number, currency, any exchange rates that may have been applied, and even how many days you held the security for. As useful as this information may be in providing you a daily view of your gains and losses, or helping you review your year-end tax calculations, it is not intended to be an official tax document. For tax planning, we provide annual trading summaries, statements, and confirmations, all of which can be found in e-services if you're registered for online statements. Dive into the details around how you did on your previous trades using the Gain and Loss tool in order to better understand your historical trading performance.
All right, so during this session, you've given us some pointers on specifically looking at our taxes most of the year. I know you do it, of course, because this is what you do day in and day out. So that's one piece of item to consider. What are some other planning strategies that we really need to do when we're planning for our yearly taxes?
Yes. So one of the first ones is basically deducting interest. I can tell you that, everybody that ever talks about a loan, the first thing out of their mouth is this a loan where I can deduct the interest? And basically, when you're thinking about repaying any debt, you should repay debt that has non-deductible interest first, because you're really not getting any other benefit from that perspective then. And then you look to debt that has deductible interest or debt that qualifies for non-refundable credit. So things like student loans. That's when you start looking to those kinds of investments. The other thing is when you're looking to borrow to invest, or when you're looking to borrow money, you should also always be considering borrowing to invest or borrowing for business purposes before you consider borrowing for a personal purchase. You should be using after-tax money for any personal expenditures. Now, the one thing is, if you did borrow to invest, and then you subsequently sell the investment even at a loss, that interest continues to be deductible as long as you reinvest the proceeds of sale of that investment. If you're doing that sort of thing, though, make sure that you are tracing the money, that you have a good paper trail from point A to point B, that's what you've been doing. The one caveat to all this, though, is remember, if you live in Quebec, Quebec does have some rules with respect to interest deductibility. So you need to be careful that you don't fall offside of those. So that's basically a few little things to keep in mind when you're talking about interest. I don't know if you want me to just go on to a few more, but if if there's any questions about that.
No, I think that's a really good summary of it. And I know there are other planning strategies that I'm kind of interested in. I know we hear a lot of talk about capital loss and capital gains. And how do we use these effectively?
Well, that capital gains obviously is one of the most, at this particular point in time, preferential ways to receive your income, because as we know, capital gains, basically only 50% of the gain is taxed at whatever your marginal tax rate is. So a lot of people really, appreciate having their income coming from basically selling capital assets that appreciate in value, like the shares of a publicly traded corporation, because then basically you get 50% of whatever the growth is tax-free. And the other benefit of them is if you do have any underperforming securities and they're in a loss position from what you bought them at, by selling those securities and triggering the loss, you can actually apply that loss to capital gains that you realized 3 years prior to when the loss is created, or indefinitely moving forward. So this is actually looking at your portfolio and looking for opportunity to trigger losses, to actually sell securities at a loss, is part of effective tax planning, because you use that opportunity to offset gains, whether in the future or in the recent in the recent past. So, that's actually something that we suggest to clients, to be looking out for that opportunity throughout the year. So, with other types of investments, sort of mutual funds, for example, if you're coming to the end of the year, that's the time to consider, when it comes to mutual funds, whether it's a good time to buy or a good time to sell a mutual fund, because then you can consider a little bit about the timing recognition of the income. But know this: when you acquire a mutual fund, sometimes income is allocated to you that was actually earned before you purchased it. So be careful of that, because if all of a sudden you're purchasing a mutual fund and sort of not being cognizant of the fact that suddenly you might have an income inclusion, landing a little bit offside because you suddenly have income that you weren't expecting. Certainly, charitable donation planning. One of the biggest sort of gifts, for lack of a better word, in both directions that you can get is the idea of how being philanthropic, in other words, giving to charity, can actually also give you a tax benefit, because obviously we get the charitable donation receipt. And what some people may not appreciate is, if you actually donate publicly traded securities in kind. So if you own, a certain publicly traded security, and you say, I am actually donating that particular security to the charity of your choice, the capital gains are actually not realized, and you still get the charitable donation receipt. So basically, the income isn't realized when you donate those publicly traded securities in kind, and you still get the donation receipt that you can apply to your taxes for that year. So that's a really great way to actually help your tax situation a little bit. Of course, if you are a new home buyer or a first-time home buyer, those incentives are really great to look into. So one of the incentives is that you can withdraw $35,000 from an RSP under the home buyers plan. And if you purchase your principal residence, you can actually pay that money back over 15 years and still continue to make RSP contributions. Finally, the last one, and like I said, these are yearly tax planning strategies, is this issue of fixed income laddering. So some people might be familiar with fixed income investments. They're things like GICs and bonds, because then basically what the laddering is that the realization of the income from those is going to happen at different times. It's not that they're all going to mature in the same year, and basically all that income is going to land on your return at the same time. So that's a few ideas.
No, those are great ideas. I know that those ideas, because a lot of those products are items that our clients deal with every day. So it's really good information for them to kind of consider over the course of this tax season. Any other considerations that we might have around this time? Sometimes we might say considerations or common mistakes that we have. Any other things that you might want to bring up today?
So absolutely. Because some people don't often sell their home, they may remember from years ago that if a home qualified as a principal residence and you sold it, you didn't have to do anything. That rule has changed. So now you should be aware that if you sell your principal residence in a particular year and you intend to claim the principal residence exemption on the proceeds of that sale, you need to file a form. It's a T2091 in order to actually claim the exemption. And if you don't, if you forget to file that form, the CRA is not going to be forgiving. And a lot of people don't realize that the Canada Revenue Agency now gets notification of the sale of all property in Canada. And at any time, they seem to be about 2 years behind. But we have had clients who basically have sold a property, didn't realize they have to file the form, and 2 years later, 2 or 3 years later, the Canada Revenue Agency contacts them and says, hey, you sold this property a couple of years ago and you didn't claim the principal residence exemption, so we're now basically assessing you with the tax, interest, and penalties. So that can be a rude surprise. TFSAs, one of the most common questions that I get from people sometimes is, now, a TFSA is supposed to be tax-free. Why is it that I sometimes get taxed or get tax withheld in a TFSA? And the reason for that is because people don't realize that while TFSAs are tax-free in Canada, the United States doesn't concede them as a registered account. So basically, if you're holding U.S. securities in a TFSA, if you receive U.S. dividends, then there is 15% U.S. withholding tax on those dividends. Canada may not tax it, but the U.S., the IRS, wants their money. So that's why sometimes you see taxation within a TFSA. So it's something to think about. When you're looking at what your investment portfolio is going to be within your TFSA. The other thing, of course, to be cognizant of with respect to TFSAs is over contributions. That's very important because if you do have an over contribution, you're basically going to pay 1% penalty on the maximum or the highest amount of that over contribution for a particular month on a monthly basis until the money is taken out. So when it comes to TFSAs, that's a reason to think about, when you're going to be putting money into the TFSA or taking money out of the TFSA. There are better times during the year to do that than others. And as well, if you are doing frequent trading within your TFSA, you need to be very careful about that because there are certain rules for TFSAs called advantage rules. And as well, frequent trading within a TFSA could flip that trading over into, I guess, what's commonly called day trading, and therefore be seen as actually conducting business throughout your TFSA. So that's something to be very careful about. As you can see from the slides, foreign exchange gains and losses, when buying and selling foreign securities, that's something that you have to be really careful about because what I've seen sometimes is when it's not taken into account, suddenly you have a much greater capital gain than you were expecting because, maybe our dollar is a little bit low at this particular time. Or on the flip side of that, you're expecting a certain capital loss and it's much less of a loss, if I can use a double negative, than you were expecting. So that's another thing to really keep in mind. And as well, we talked a little bit about trust. But if you are a trustee of a trust at any time, there is a 21-year deemed disposition rule. So the idea is for many trusts, not all. So that's another tip to sort of find out if the trust that you're involved in has this deemed disposition rule. And if you do, you should start planning for that at least 5 years before you get to that 21-year deemed disposition. Because basically, as I explained before, disposition means a pretend sale. And it can have, a trust can have significant tax consequences if all of a sudden in a particular year, everything the trust owns is basically considered sold, whether it is or not. So other things, the stock exchange cutoff, what is the last day to execute a sale in order for it to be counted in a particular year? A lot of people think that they can trade right up until December 31st. That doesn't usually happen. I think for 2020, the date was, I think, December 29th. So keep that in mind. And please, if you are considering joint accounts, like let's say you have an account in your own name, you're considering adding your spouse or adding a child, get good advice. There are significant tax and legal repercussions when it comes to joint accounts. And on the one hand, it might be easy to do. You can come into the bank and say, I want to add my daughter, or I want to add my spouse to this account. And so from an administrative perspective, that's not always hard to do. But that doesn't mean there might not be tax or legal consequences to doing that. So that's something, if you're thinking about it, make sure you get good advice about from a lawyer or a tax accountant or some other professional advisor.
Georgia, I can't tell you how amazing it is to look at all those considerations. It really is. They really are items that people have to consider along the way. So we're going to take a quick moment, and I promise you it won't be as good as talking with Georgia, but I want to show you the DI, or the Direct Investing Resource Center in WebBroker, just to show you where you can get some resources as you consider your taxes this year. So let's check that out in a moment.
Welcome to WebBroker. From the home page, or any page for that matter while signed into WebBroker, click on the Accounts tab. Under the More Self-Service heading, go to Tax Information Center. The Tax Center lists some of the most common links and questions. Let's try one. This link looks helpful. Here, we can find a link to a webinar. We can see some important dates to consider during this tax season, such as the last day for RSP contributions and the last day to file your tax return without incurring a possible penalty. What tax documents does TD Direct Investing provide, and when should I expect them? This is a great place to find out when TD Direct Investing will make tax documents available for both registered and non-registered accounts. To go back to the main page, click Back. What if you have a question that is not shown in the Tax Center links? Well, try typing it in the box. If I want to know how to make an RSP contribution, I can ask, how do I make RSP contributions? As I begin to type, the auto search function finds the most similar questions. No need to type the whole thing, just click on the question that appears most similar to yours. There you are. Visit the TD Direct Investing Tax Information Center today.
Georgia, thank you so much for going through a lot of this information. I really, really appreciate it. I know our clients appreciated it.
Thank you so much. I'm really happy to have been asked.
And for those in the live session, we now move on to questions.